Why mutual funds? What we don't do is we don't plan over time. What we actually need to do is have a portfolio approach to diversify risk. I like funds because this is a product category which allows us to do that in an efficient manner. You're making a target and then you're using the product to get to that target. Because most people don't save for the long term, don't invest for the long term, thinking, what if I needed the money right now?
We've all seen the mutual fund Sahi Hai campaign. It was a huge campaign actually, and even the likes of Sachin Tendulkar and MS Dhoni are being roped into campaign now. So clearly the campaign seems to have done its job, because in 2019 alone, mutual funds added 9.55 lakh in SIPs each month, which is a huge rise. But the mutual fund Sahi Hai campaign didn't tell us one vital thing. What's so Sahi about mutual funds? So let's try to find out in this episode with Money with Monika. Monika, we've discussed the merits of investing for the long term, but why mutual funds? What is so sahi about them, so correct about them for the investor?
The most asked question is, does this product give me the highest return? And we think of it discretely, like today I will do this and then next year I will do something else. What we don't do is we don't plan over time. We don't think of our entire financial life as a continuum, and then we don't think of using financial products over a series of years to solve our problems. So what we actually need to do is have a portfolio approach to diversify risk, to solve our problems and work towards goals. And I like funds because this is a product category which allows us to do that in an efficient manner without having to rethink our goals, our approach, our strategy every year.
Right. I think it is the understanding that a lot of people stumble on. So let's unpack that a little bit for people.
Using the array of products which are there, this product category allows you to build a portfolio which then helps you to target your future goals. So let's look at something like an emergency fund. Now, most people don't think that an emergency fund is that important, but it is one of the most important. It's the starter financial product, because most people don't save for the long term, don't invest for the long term, thinking, what if I needed the money right now? So for an emergency fund, a person has the option of buying a fixed deposit, investing in a fixed deposit, or to target a slightly higher return, keeping the risk low. So then again, you need to get into the product to understand what it is. You can use the product, mutual fund, like a short-term debt fund. For seasoned investors, you can even go up the risk ladder, understanding what you have, and then you can build that fund. And then for your short, medium, long-term goals, you will have to make those goals rather than think of just that this product is giving me 14% return and this is offering 5%. You're making a target and then you're using the product to get to that target.
So what we're seeing as more and more people who come into the mutual fund fold is that people understand mutual funds as a good product that will inevitably give them great returns in the long term. But that can't be true as a generalization, right? I mean, people have to unpack that a little bit and understand that.
That's right.
So, but you keep recommending mutual funds as a great investment product for retail investors. Why is that?
We'll have to take a little bit of a walk down memory lane. The mutual fund regulations came into being in the aftermath of the Harshad Mehta scam, which was this big stock market scam where retail investors lost a lot of money. And the policy view was that modern financial products seeking retail household investors in India need a safe way to access these products. So mutual funds in India have a 3-tier structure. There is a sponsor with a business interest, and he's the originator of the business, and he hires the asset management company as a fee for service provider, but the money is held in trust. So there's a trust. Mutual fund in India is actually a trust. It's not the AMC. The AMC is a service provider which gets a fee. The money is held in trust in the name of the investors by the trust to be invested into products which have a specific investment mandate. The trustee rules say that the liability on the trustees is unlimited. Their personal assets can get attached, they can go to jail. So that the trust structure is one of the strictest structures to protect the beneficiary. The beneficiary is really the investor because it's his money. The asset management company is just a pass-through, which is why you would have never heard of an asset management company running away with investor money. So they haven't decamped with anybody's money. We need to remember that the risk that we worry about is about markets going up and down. That's the volatility risk, or the risk of the fund manager not performing. That's your entry part. Of course, after that, it's not a guaranteed product. I mean, they are by regulation not allowed to say the word guarantee. It is, they go on saying it's a market-linked product, it carries risk. You have to understand the risk that you're getting in. And SEBI also has this thing called a riskometer, which sort of indicates at what level of risk this particular product carries. The one that you're trying to buy, what does it carry? So, there are a lot of things in the market, but you do your due diligence also.
I think that risk and that garbled little disclaimer of mutual fund investments not subject to market risk sends the red flags up. But I understand the larger picture that you're talking about, that, at least the scariness of somebody running away with your money that's in a Ponzi, that's not going to happen. So suitability is important. Does this really suit the need of the investor?
that absolutely, it's a great question that are these products suitable? And the answer is, it depends on how well, one, you understand what you need, and two, how well you're able to pick the product that is either being sold or you're choosing. Now remember that there are more than 30 categories of mutual funds. SEBI 2 years back had cleaned up the industry and made it what is called true to label. What this means is that there's a bus stand and you're getting into a bus and it says Noida, but you end up in Gurgaon. So the bus was not true to label. It was saying it's going there, but it actually went somewhere else. Now, after this classification, funds have got really true to label. So if a fund is saying that it's a large cap fund. If a fund is saying it's a conservative hybrid, which means it has less of equity and more of debt, it is actually that. So the suitability question is really understanding your own need and then finding out of these 30 categories, which is the category which I should look at.
But that 30 product categories can be intimidating for a lot of people. So how does one even start to use this product category? I think that's difficult for most people still.
Correct. Financial products are invisible, so you don't see where the costs are placed. There used to be a 2.25% commission sitting in the product. So if you invested 100, not all of it went to work. 2.25 went to the agent selling you, and this number could get higher because of a variety of reasons. In 2009, SEBI said that there is now if 100 rupees invested, 100 rupees goes to work. And remember, in a life insurance product, this number is not 2.5 rupees, it's 35 rupees on 100. That's the difference. So now you suddenly know why they chase you so much, because on 100 rupees, they're getting 35 of commission. But this commission then got put into the end of the product, which means it's a trail, which means that if you stay for a year, then the agent selling you gets 75 bips or a percent.
Okay.
The industry then began to collect this trail and pay it upfront. SEBI has banned that as well. So now really, they have to sell you the product which is most suitable to you, because they will benefit when you benefit as you stay longer in the product. An entry-level category is the index fund or the exchange-traded fund. These are the simplest products to ride the market long-term. So, an index fund on the Sensex or the Nifty 50 gives you the market return. So, remember, when you choose a managed product, you are getting the fund manager to pick stocks or bonds and give you a return which is higher than market return. But if you want to start yourself and you don't know much, an index fund or an ETF is a really good place to start putting your toe in this water, to even understanding the market with minimal long-term risk. Short-term volatility is there, but over the longer term, markets do well. Stock markets in a growing economy like India do well, and you get that benefit.
So on that note of what to choose and how, we'll take a viewer question. So V. Ramcharan, who's a farmer from Eluru in Andhra Pradesh, writes to us that he has 35 acres of farmland and around 2 crore in cash financing. He also has a 5-year-old daughter and he's been investing for her future through a Sukanya Samriddhi Yojana. But now, interestingly, he wants to shift to mutual fund investing. And he has a lump sum of around 50 lakh that he wants to put in a Nifty Next 550 fund for the long term, and another 25 lakh or so that he wants to put in multi and mid cap funds. So is he on the right track? What should he do?
Yeah, I'm delighted that, when people like farmers who traditionally have been out of the formal finance begin to look at mutual funds as the possible route to their financial goals, I think it's a really good idea. So yes, Ramcharan, I think it's a great idea that you are thinking of shifting, and your first thoughts look very, very sensible, that you want to choose an index fund, but possibly in that index you're saying Nifty Next 50, maybe take a blend of the Nifty 50 along with the Nifty 50. So I understand that you've already done a lot of homework in terms of saying that if I have a long view, then I can take the risk of a mid-cap product, but just hedge your risk a little bit and go easy on putting your money all in the Nifty Next 50. Do broad base it with a broader market index. And also my suggestion would be, do not go to the market one day and buy for that entire amount. Stagger it over at least a year, because we don't know what happens. Markets are volatile in the short term, but sensible over the long term.
Ramcharan, I hope that answers your question. And that's all the time we have. So thanks for tuning in. And in the meanwhile, if you want Monika to take your questions in the next episode, do write into us at moneywithmonika@livemint.com.
An investor education initiative by ICICI Prudential Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.